Two most common ways to exit a business are, number one, through some type of internal succession plan, where you've worked with your team, your partners, your employees, your staff, and built a plan that transitions your ownership to their ownership at a certain point in time or over a period of time. The second way to really transition out of a business is what I would call an arm's length transaction, where you would actually understand the business that you've built, what it's worth, that it is something of value, and then how to transition that value to a third-party buyer via an arm's length transaction that we call an acquisition. When preparing your business for sale, we recommend working with your team of advisors and providing at least a 3 to 5 year time horizon. That's really the best case scenario. This will give you an opportunity to have your team understand your business, look at the historical financials, the operations, and make some recommendations on things that could be improved over the next period of time so as to set you up for success in maximizing the value that you sell your business for. When preparing to sell your business, it's important to work with your advisors to understand what the timeline and the process is going to look like, and try to identify key areas that you, the business owner, can work with your team to maximize the value of the business upon sale. The first stop here is what we call the corporate record review and cleanup. Chances are you formed your corporation or your limited liability company many years ago, and some filings have been done and maybe others haven't. And so when you go through selling your business, there's a process that's called due diligence, where the buyer is going to take a look at the public record to understand what shape is your business in. So in working with your team of advisors to help review and clean up those corporate records from the past can really help maximize the value in the sale of your business. Yeah, so when we look at selling a business, generally speaking, there are two schools of thought. There's what's called the stock sale, and then there's what's called the asset sale. With a stock sale, you're looking to take the company that exists and transition ownership of that company, of the stock in that company, to the new buyer. Quite often, buyers don't want to acquire the stock of a business. They would prefer to have a clean break, and that's where the asset sale comes in. This is where the buyer will form a new company, and it will buy the tangible and intangible assets from the seller company. There are tax considerations for both that your CPA and accounting team will weigh in on, but one that carries through is really, how the company is taxed, both as a seller and a buyer. One that's specific as to the asset purchase is how is the allocation of the purchase price going to apply to the tangible assets, and then how is the allocation going to apply to the intangible assets, like goodwill or trade name or something like that. And each of those categories have different taxations, and it's important to understand that while working with your team of advisors on the terms of the deal at the negotiation phase, so that you can set yourself up for success at closing. Absolutely, without question, the most common way that we see a business transitioned for value is through what's called an asset purchase agreement. This is where the buyer is forming a new company and it's buying the tangible and intangible assets from the selling company. And so what you might have is, let's take, for example, a dental practice. ABC Dental PLLC operates for business and decides the dentist is going to retire. That company is going to sell its tangible, things you can touch, assets, and intangible, things you can't touch, assets, to the buyer's newly formed company that is XYZ Dental PLLC. Those tangible and intangible assets are going to transfer title, and it's the job of your advisory team to work with you to make sure that that title is transferred in an efficient manner, making sure it's free of all liens and encumbrances. And again, the most common way that we do that is through the asset purchase agreement. So if you own a business and you're thinking about exiting or selling the business in the next 3 to 5 years, feel free to give us a call at NC Planning. Our team is standing by and we would love to help.